So you're thinking about bringing your business to Canada, huh? That's awesome. But I bet one of the first things that pops into your head is taxes. Is it going to be this giant, complicated headache? Well, the good news is it's really not as scary as it sounds. Over the next few minutes, we're going to pull back the curtain and demystify the whole thing. I'll give you the absolute must-knows, the rules, and even some smart strategies. All right, so here's the game plan. First, we'll tackle the one core rule that everything else is built on. Then we'll get into setting up shop in Canada, what taxes you'll actually be paying, some clever ways to grow by buying a local company, and finally, how to make sure you're playing by the rules. Sound good? Let's dive in. Okay, first things first, we're starting with the absolute foundation of the Canadian tax system. Seriously, if you get this one idea, everything else just clicks into place. So when the Canadian tax authorities look at your business, what's the number one thing they want to know? It really all boils down to one single, super important question. And the answer is all about one thing: residency. It's a simple fork in the road. If you're considered a resident, you get taxed on your worldwide income, everything from everywhere. But if you're non-resident, you're only taxed on the income you make from Canadian sources. That's it. This one single difference is the launchpad for literally every single business decision you'll make from here on out. Okay, so keeping that resident versus non-resident idea in our back pocket, let's talk about your first huge decision when you're actually ready to plant your flag in the Canadian market. It really comes down to two main paths. Are you going to operate as a branch, which is basically just an extension of your existing company, or are you going to create a subsidiary, a whole new separate Canadian corporation? And this is where things get really strategic. See, with a subsidiary, you pay your standard corporate tax. Simple enough. But when you want to send profits back home, you'll pay a withholding tax on those dividends. Now, a branch, it's a bit different. It gets hit with an extra branch tax right away on its profits, and it doesn't matter if you send that money home or not. But, and this is a big one, here's the real kicker, especially if you plan to sell one day. Selling the shares of your subsidiary, that can often be done completely tax-free. Selling the assets of your branch? Nope, you're almost definitely going to be paying Canadian tax on that. That's a massive difference for your exit strategy. All right, fast forward. You've picked your structure, you're open for business, so what taxes are you going to see on a day-to-day basis? Let's run through the big ones. First up, you've got the federal corporate income tax. The base rate is 15%. But, and this is important, that's just the federal part. Every province adds its own tax on top of that. So your real all-in tax rate is going to change depending on which province you set up in. Now, this next part is actually one of the coolest features of the Canadian tax system, especially if you're an investor. The whole system is set up to encourage you to invest, to buy and sell assets. We're talking things like property, equipment, shares, you name it. And they do it with a really powerful incentive. And here's how it works. It's actually super simple. Let's say you sell something and make a profit. That's called a capital gain. You only have to include half of that profit in your income for tax purposes. The other 50%, it's yours, free and clear, no tax. That is a huge, huge advantage. Okay, let's switch over to sales tax. At the federal level, there's a 5% tax called the Goods and Services Tax, or GST. Now, some provinces have gone a step further to make it easier and have merged their own sales tax with the GST. That's called the Harmonized Sales Tax, or HST. Either way, as a business, you're the one who has to collect it from your customers. But the system is actually really fair to businesses. Here's how it works. First, you charge the GST or HST on whatever you sell. But, and this is key, you get to claim back all the GST or HST you paid on your own business expenses. Think rent, supplies, whatever. These are called input tax credits. So in the end, you only send the difference to the government. It's a flow-through system, so the final customer is the one who really pays the tax, not you. Okay, let's jump ahead a bit. Imagine your business is doing great. You're successful and you're thinking, what's next? A really common way to grow is to just buy an existing Canadian company. So let's talk about how to do that. Now, you could just go and buy it, but there's a much smarter way to structure the deal that can save you a lot down the road. It involves using a little tool called a Canadian Acquisition Company, or CAC for short. It might sound complicated, but it's really just 3 steps. Step 1, you create this new empty company, the CAC. Step 2, you'll put your money into the CAC, and it goes and buys the shares of the company you want. And step 3, you just merge those 2 companies together. Boom, they become one. So why bother with all that? What's the big payoff? Well, here it is. By doing it this way, the money you used for the purchase basically gets converted into a special kind of capital. Think of it like creating a pool of your original investment money. And later on, when you want to take that money back out of Canada, you can do it completely tax-free. It's an incredibly powerful way to get your initial investment back home without any tax headaches. All right, and for our last stop, let's talk about the guardrails. Every system needs rules to make sure everybody's playing fair, and Canada's is no different. There are a few key principles designed to keep everything on the straight and narrow. First up is the big one, known as JAR. The easiest way to think about this is the spirit of the law rule. It basically says, look, you can't just find a clever loophole to avoid tax. Even if what you're doing is technically legal by the letter of the law, if the only reason you're doing it is to get a tax break in a way that feels like you're abusing the system, the government can shut it down. Next, we have something called transfer pricing. Imagine your Canadian subsidiary is buying something from your parent company back home. What's to stop the parent company from charging a ridiculously high price to pull all the profit out of Canada? Well, that's what this rule is for. It says any transaction between related companies has to happen at a fair market price, what they call an arm's length price. You have to act as if you were dealing with a total stranger. It keeps everything fair and stops companies from just moving profits around to find the lowest tax rate. And finally, there are the thin capitalization rules. Here's the potential problem they solve. Since interest payments are tax-deductible, a foreign parent could just loan its Canadian company a ton of money instead of investing equity. Then they could suck all the profits out as interest payments and get a tax deduction for it. So Canada put a stop to that. The rule is simple. Your debt from these related parties can't be more than 1.5 times your equity. It's a 1.5 to 1 ratio. If you go over that limit, you just lose the tax deduction on the interest for that extra debt. So let's circle all the way back to where we started. After looking at all this, the core rules, the strategic choices, the guardrails, what's the verdict? Is the Canadian tax system a giant wall, a barrier to entry, or is it more like a structured pathway for your business? While there are definitely things to learn, the system is pretty logical. It's predictable, and for the entrepreneur who takes a little time to understand how it works, it's not a barrier at all. It's actually a pretty clear roadmap for doing business successfully in Canada.